Good afternoon. This is Frank Berrodin of Miller Johnson. I'm going to give you today a year-end retirement plan review update as part of our monthly benefits lunch break webinar series. Today's I'm going to try to focus on things that are related to retirement plans and year-end things that you should be thinking about. Next month, we will have our year-end question and answer session. And so there were a couple of questions that were submitted for this session that were very specific and not necessarily related to what I'm talking about. So we will try to address those at next month's session. And certainly feel free for that one to submit questions, anything benefits related. We will not have any topic ahead of time, simply questions and answers regarding benefits issues that you would like to see us address. So that one is always a good one for getting unique things addressed that may only apply to one or more clients. But this one, I'll try to focus on things that have a little more broader application related to specifically retirement plans. So also, if you do have specific questions related to what I'm talking about today, you can submit a question and I will try to answer it here. And certainly feel free to do so because the material that I have today is not that long. We will definitely finish in less than 30 minutes. And so there will be time if there are any things that you want me to address related to kind of retirement plan year-end issues. The first thing that I'm going to talk about is not new, because you probably, if you participated in this webinar last year. The first thing that I'm going to talk about is not new, because you probably, if you participated in this webinar last year at this time, I addressed the new safe harbor deadlines. And I put that as the first slide again this year because we had rules in place for so long and now they're different. And so this is the second year of it being different, but I still want to make sure that everybody is aware of the changes. So we still have a December 1st, 2022 deadline if you want to be a non-elective safe harbor plan for 2022, and you didn't hardwire that into your plan at the beginning of the year and provide a notice before the beginning of the year that you would be a safe harbor plan. You still have to make that decision, adopt an amendment, and notify the participants by December 1st. If you were willing to make a 4% safe harbor contribution, you would have until December 31st, 2023. So if you want to keep it at 3%, you need to do it by December 1 of this year. But if you're willing to go up to 4%, you have an extra year. Of course, if you're a safe harbor matching plan, then you had to have notified people before the beginning of this year to be safe harbor for this year. But you would have to notify by December 1 of this year in order to be a matching safe harbor plan for 2023. At the bottom here, I've just said, verify that your safe harbor notices, your automatic enrollment notices, your qualified default investment arrangement notices. It seems like there's a million notices nowadays. So it's just very good to confirm that all of those are being provided. And in many cases, you can provide them all in a single notice before this December 1 of 2022 deadline that would apply if it was a safe harbor plan. So just make sure you're aware of all those notice requirements. Unfortunately, some of them have significant penalties if you miss the deadline. Next thing I'm going to cover is the 2022 dollar limits. Now, you may say, well, we've seen this. There's been many publications that have had information about them. And that's true. The things I think that need to be, you need to be aware of is that obviously these limits increased more than they ever have since these limits have been around. In some cases, they went up by more than 11%. And that could potentially have some changes or even some opportunities that you might have to restructure things so that you can potentially provide greater benefits to certain participants. For example, the compensation limit for being a highly compensated employee went from $135,000 a year to $150,000. if you have some people that are on the border line or that were previously highly compensated that might now become non-highly compensated, you may be able to provide significantly enhanced qualified retirement plan contributions for those types of employees. It may be an unusual situation, not that you're going to do this broad-based, but it gives you some opportunities to make additional contributions for certain people without having to worry about non-discrimination testing if they are non-highly compensated. So that's something to be aware of. And if you have somebody who you're considering hiring and they feel strongly about getting much larger retirement plan contributions and are willing to accept lower rate of compensation, you can keep them below the limit and then provide them basically up to $66,000 a year in retirement plan contributions. And that could be what enables you to hire somebody when some other employer was not able to do that or was not aware of the ability to do that. So that's the kind of thing to keep in mind with these significantly increased limits for 2022. Actually, that should be for 2023. At the top, I should have said 2023 limits, not 2022. The next thing I'm going to cover very quickly is kind of this whole concept of what's referred to sometimes as backdoor Roth contributions. Now, there's really two pieces to the Roth that you need to be aware of. The first one is the ability to convert pre-tax contributions to Roth. Once again, my slide there says after-tax contributions. It's really pre-tax contributions that participants may consider converting to Roth. They can also convert after-tax contributions, but the first situation that I want to cover is converting pre-tax. And so that, for example, let's say an individual has been an employee for 30 years, and they have accumulated a significant amount in their retirement plan. And let's say they just never contributed on a Roth basis. It was always pre-tax. And maybe that was because the plan didn't allow Roth contributions, or if it did, they just didn't take advantage of it. Well, now their investment advisor or tax advisor is telling them, you really should have some in Roth and some in pre-tax so that in retirement you can take money out of whichever source is better for you from a tax standpoint. Well, there is a way to do that other than just making future contributions as Roth. You can convert a portion of the pre-tax money to Roth. You have to pay tax on it now, but then it's, if you qualify for the Roth distribution, basically has to have been Roth for at least 5 years, then you don't pay any tax on the distribution. So if you think of the ideal scenario, the best time to do this is right after a market downturn. So take the simple example of, let's say an employee or participant in a retirement plan had a $1 million account balance. They're a long-time employee and they're going to retire soon. And the stock market goes down so dramatically. Let's just talk about the extreme. Hopefully this will never happen, but it goes down 90% in value. It's now worth $100,000. If they convert that to Roth at that time, they pay tax on the $100,000. Let's say we get a post-COVID type rebound where it goes right back up to the $1 million. Now they only had to pay tax on $100,000, and then they would pull their money out later and they would receive the full $1 million tax-free. So that's a classic way or example of how this can be beneficial for certain people. Obviously, that kind of market downturn is unlikely to happen, hopefully, but it is a way that things can be done to benefit participants from a tax standpoint by proper planning, and the plan has to have this provision in it that allows in-plan Roth conversions in order to do that. So that's the first thing, is the consideration of whether to allow pre-tax contributions to be converted to Roth within the plan. And more plans are now allowing that. The second way of doing this is really the true backdoor Roth contribution, which is you make after-tax contributions. So these are not your typical 401k contributions. They're called after-tax contributions, and they're not Roth contributions. So they're not subject to the $22,500 limit. And then immediately after making them, you convert them to Roth. And so it is a way to get much more money potentially into the plan as a Roth contribution than you would be able to if you couldn't make these after-tax contributions. The big challenge with these is that there is a special non-discrimination requirement that applies to the after-tax contributions. So unless a number of non-highly compensated employees are making these types of contributions, the highly compensated, who are the ones most likely to be able to have the discretionary income to make, as I've shown in my example, a $66,000 contribution, it will be unlikely to satisfy non-discrimination if only the highly compensated employees take advantage of this. But you may still want to add it, because once again, in the consideration, let's say you're hiring a new executive. You hire a new executive, it doesn't matter if their salary is $1 million a year. In the first year that they are employed, they are not a highly compensated employee so long as they're not at least a 5% owner of the business. So once again, that's a great marketing tool to tell that executive, look, we have this provision in here where you can make an after-tax contribution of up to $66,000, immediately convert it to Roth, and you'll never pay tax on the earnings on that if you hold it and take it out at the time of retirement. So there are situations where it can be very beneficial. It also ties back to that, what I was talking about before, whereas if you might be able to structure somebody's compensation to keep them below the $150,000 and they're a non-highly compensated employee, then they could take advantage of this as well. But certainly for the newly hired executives, in the year they're hired, and some cases in the second year as well, they're not a highly compensated employee. Let's say, for example, you hire an executive right now and their compensation is going to be $500,000. Well, they probably won't earn over $135,000 between now and the end of the year. So they're not a highly compensated employee this year automatically, and they won't be next year either. So that they could get 2 years of this. That's now $132,000 that they've been able to shelter from taxes for until retirement. And so that can be very beneficial. All right, required amendments for 2022. As I indicated, I'm just going to be jumping around for a lot of things are fairly quick, because that's kind of the way things go at the end of the year and why everybody's so busy, because you guys got a lot of little details to take care of. Fortunately, the required amendments for 2022 are very minimal. You really just have to have amendments adopted by the end of this year if you made any discretionary changes this year, because originally the Secure Act amendments and the CARES Act amendments were going to be required by the end of this year. That was extended till the end of 2025. Now, do you want to wait until 2025, especially for some of the CARES Act provisions? And the CARES Act was the act that allowed you to make special distributions and loans during COVID. And so that was 2020. By 2025, half the people that were involved in making the decision whether to allow that under your plan may not even be there anymore, be working. We just think that it's kind of risky to wait until 2025 to try to do that amendment. So we're thinking that 2023 might be a good year to do it, partly because there may be some other changes that need to be made in 2023. And so, and hopefully we'll have all the IRS guidance that we need to have those amendments done. So you might want to be thinking about that. So the only thing for 2022 that you have to be aware of is if you have a Code Section 457B plan and you are a non-governmental tax-exempt entity. For some strange reason, the IRS did not extend the deadline for those plans. So tax-exempt 457B plans do have a December 31, 2022 deadline to amend for the Secure Act. So if you have one of those plans, If it was drafted by us, we will be sending you the amendment to accomplish that. If you have one through a different provider, you'll need to make sure that you get that amendment and have it signed by year end. Another thing I want to cover quickly, even though this is also not new this year, is the change to minimum required distributions. Obviously, that age has changed from 70.5 to 72, which is a good thing. And after a participant dies, the distribution period was really extended from 5 to 10 years, but those payments have to be made annually over that 10-year period. But the main reason that I want to discuss this quickly is you have to make sure that you are trying to locate missing participants who may have reached that age 72. And you can't just say, oh, we tried to contact them, we couldn't find them, so we didn't start their payment. That's not good enough. The IRS has issued guidance that lists the steps that you have to follow, and I've laid them out here on this slide. You have to do some searches, and one of the big things that you have to do, and this is not, there are a couple of search options. You can choose one of these, but in addition to that, you have to send a letter by certified mail to the last known mailing address of the participant. We have a client that was recently audited, and they sent the letters by first class mail, but not certified mail. And the IRS is imposing a penalty of $75,000 and they only failed to start the payments for 2 participants. And the dollar amounts were not even very big. And yet they're imposing a $75,000 penalty. Now, we're definitely going to fight that and hopefully get that reduced. But you are much better off if you can not even be in the position where they impose the penalty in the first place by making sure you send those by certified mail. A lot of people obviously are unhappy that the IRS and the Department of Labor have both been pushing this issue because there's really very little responsibility put on the participants to keep the employer aware of changes in their address and even responding to letters that they get. But the IRS and the DOL's position right now has been, it's the employer's obligation to find them and to start their payment, even if they don't respond. If they are aware of where that person lives, even if they decline, letters, they don't respond to anything, you're supposed to start their payment once they reach that age 72. And this is part of the what's been going on in governmental audits right now. The Department of Labor has been very active in auditing plans. We've had numerous clients dealing with them, and this is one of the big issues they've been addressing, is the locating lost participants. We may see an increase in IRS audits as a result of the Inflation Reduction Act, which supposedly is going to give $80 billion more to the IRS in order to it's not just for enforcement, it's for compliance and other things, but we think a portion of it will go to enforcement, which will likely result in an increase audits. And based on that $75,000 penalty that was imposed, we know those could be significant. We had another client that recently was hit with a $95,000 penalty, and it was a 1 participant plan that filed their 5,500 during COVID and did not send it by certified mail again, sent it by regular mail, which is acceptable, except if you do that, you have to have proof of mailing if the IRS doesn't receive the submission. And the individual had no proof of mailing. Surprisingly, the Form 5500 showed up a year later, and they received it, but then they imposed this $95,000 penalty for being 1 year late for a 1 participant plan. I mean, that's the kind of example that's absolutely ridiculous that they would impose that kind of penalty. But, and once again, we're fighting it, and hopefully we'll get that reduced, but it costs money to fight it as well. So you don't want to be in that situation. One of the things to be aware of with the government audits is the IRS also came out this past summer with guidance saying that they were going to start this program where they would notify employers that they were going to be audited in advance and give them 90 days to disclose any errors that the client discovers during that time. and pay a much reduced sanction. It'd be as if you filed under the voluntary correction program. I personally have not had a client who's received one of these letters yet, but if they do, we will strongly encourage them to do a very comprehensive, like self-audit of the plan during that time period, because anything that you find, if you voluntarily come forward before the end of that 90-day period, you'll be able to fix and pay a greatly reduced penalty. You miss that 90-day deadline, or they audit the plan completely and find errors that you didn't catch, then you can potentially get hit with these much larger penalties that we've just talked about. Another thing I want to cover very quickly, because this is the good thing is you don't really have to do anything about this, but your participants are affected by this, as well as the financial advisors who advise them, is the Department of Labor in the last few years has decided that any advice to roll money from a qualified retirement plan into an IRA is considered fiduciary advice. So the advisor cannot give that advice to roll money out of your plan into an IRA unless and assuming that they are going to receive compensation once that money comes into the IRA, which is almost always true, or they wouldn't be providing the advice. They have to meet the requirements of this prohibited transaction exemption, or else they will be subject to an excise tax. So I've listed the things they have to do. They have to acknowledge that they're a fiduciary. They have to provide certain disclosures. But the big thing is they have to show to the participant why it's in their best interest to roll the money out. And they can only do that if they have significant information about the current plan and the investments under that plan. So you're likely to start seeing many more requests to provide that information so that they can include it in their analysis of the rollover. I mean, I suppose in the best of all worlds, your plan will be so good, you'll have such low costs, you'll have all these options available, like the in-plan Roth conversion and other things, where there will be no reason that participants will want to roll their money out of the plan. They'll want to keep it in the plan. And if you have that kind of plan, it's going to be tough for an advisor to explain to a client why they're better off rolling their money into an IRA. But you're going to start seeing more requests for that information so that these advisors can comply with that exemption. Next thing is I want to give you just a quick update on where we are on the lawsuits for fiduciary breaches and 401k plans. Some of the recent cases have finally started to go in favor of the employers, where they're not getting having to pay significant damages to participants for having investment options in their plans that the plaintiffs' attorneys have claimed are fiduciary breach because either the fees were too high or the performance was not good enough. So the critical thing continues to be that you follow good process for evaluating those funds. It's obviously easy to challenge in hindsight whether a fund underperformed and shouldn't have been in the lineup. But if you've gone through the process and showed why even temporary underperformance is not a reason to necessarily get rid of a fund, you'll be in much better shape in fighting off those lawsuits. And the challenge of the BlackRock target date funds, which has been quite a few cases recently because they underperformed for some period of time. Those are probably not going to be successful, and some of them have already been dismissed, partly because those BlackRock funds had very high ratings from Morningstar and other third-party sources. They just, when you compared them to certain other funds during the time period selected by the plaintiffs' attorneys, they underperformed. And so it's good that we are now getting some more balanced decisions in that area. The one area that I still think needs to be focused on, and some of the more recent cases have challenged, is the record keepers have now realized that they have to provide very low cost funds in the investment lineups in order to compete with each other. So their way of making money now is to provide those low-cost funds, but then they provide a managed account service to basically say, participants, we recognize that you need help in selecting the funds under the plan, available under the plan. So we will charge you somewhere between 25 and 45 basis points for us to advise you as to the selection of the mix of the funds that you have in your lineup. That's perfectly fine, but you need to be evaluating, as fiduciaries of the plan, your investment committee need to be evaluating whether that advice that is being provided is worth that extra cost. And the way really to do that is to compare the participants who have selected that option, their performance to the performance of the target date index funds for people of comparable ages. And then you'll be able to see whether the extra fees that they're paying for the individual advice has been worth it. Now, just because, you know, a few participants end up doing worse is not going to mean that that's, you know, a breach, but it is a way to make sure that there's a reason to continue that advice service, and also to make sure you keep negotiating the fees for it so it's as low as possible. And you really need to be doing that on behalf of the participants, not just say, well, it doesn't matter because they have to select that option, so it doesn't matter if the fee is high. No, it's really the fiduciary's responsibility to evaluate that and to get that fee down as low as possible for those who select it. And one of the other things that I want to quickly touch on is investment lineup changes that you should at least consider in your 401k plan. I mean, going into 2022, it was pretty clear that stocks were very overvalued, bonds were overvalued because they had been, you know, going down, interest rates have been going down for so long. And so it's not surprising that this year is the first year in a long, long time that both stocks and bonds had significant losses. So target date funds did not necessarily protect participants. If you had a 60-40 mix stocks and bonds, you still suffered a significant loss. That's not a, you know, the end of the world for people that are younger and still accumulating assets towards retirement. It's very likely that those will both recover and the losses will be paper losses only. But where it is significant are for those people that are close to retirement or early stages of retirement, because both of those assets underperformed and had losses, and those participants may be needing to live on that money in the very near future if they are not already. And therefore, they have to be selling those assets at a loss, basically, not a good time to sell them in order to meet their expenses in living. So the things to start considering are whether the plan that you offer has other options available, certainly for people that get close to retirement, or have other investments that do not correlate with the returns of stocks and bonds. And so things this year that worked very well for that are things like commodities. Now, I'm not a big fan of putting things like cryptocurrencies in retirement plans, and that's a whole nother topic that can be discussed, because there obviously are other people that are, but certainly other types of real assets, farmland, you know, real estate, oil and gas, those kinds of things have performed in some cases very well this year and have been more of a balance. It's not, you know, the investment world is much broader than just stocks and bonds. And so that's one of the things that employers hopefully learned this year. It would have been great if they learned it last year before the downturn, but still, you always just have to keep going forward and learning from these types of things, and hopefully providing things that will help participants in the future. Next thing I'm going to talk quickly about is potential year-end legislation. The Secure Act 2.0, you've probably heard about it. It's been talked about for, you know, most of the year, has not been passed yet, but passed overwhelmingly by committees. And so it is very likely to pass by the end of this year, but we'll see. That's the way the Secure Act, the original Secure Act, passed in the year-end legislation in kind of the lame duck session at the end of the year. Some of the things had effective dates of 2023 with expectation that it was going to pass earlier in the year. I think there's no way they'll keep any of those 2023 effective dates, so it'll now be 2024. But if this passes, there are a significant number of things that will that'll be included in that: changes in catch-up contributions, required minimum distribution changes, the age getting pushed out, and just a whole bunch of other things. So, but one of the things that's in the Secure Act, not Secure Act 2.0, is the provision about covering, plans having to offer the ability of participants who have long-term part-time employees. If they've worked over 500 hours a year for at least 3 years, beginning in 2024, they have to be given the option of contributing to your 401k plan. That is already in effect, but it already has been passed. It's just not in effect till 2024. If the Secure Act 2.0 passes, it may reduce that requirement to only 2 years. But you need to be thinking about that in 2023 as to making sure you have the tracking those hours, and that you offer, beginning January 1, 2024, the ability of those employees to contribute to the plan. Another thing that has passed in the House, but not the Senate, is the Mental Health Matters Act. And in this provision, has nothing to do with mental health. There are provisions to eliminate the ability of plans to require mandatory arbitration of retirement plan claims. So this is directed at these class action lawsuits for excessive fees. Some plans have added mandatory arbitration to try to cut that down. If the Mental Health Matters Act passes, you wouldn't be able to do that. But the even bigger one is that it would eliminate the deference that currently exists in retirement plans to the plan administrator's decisions. Right now, if you challenge that decision, you have to appeal it, and then you can go to court after the appeal. But the plan administrator's decision will not be second guessed by the judge unless it was arbitrary and capricious. If this law passes, a court will just look at it fresh without even taking into account the decision made by the plan and make their own decision. So this would be significant, and it's possible it could get rolled into the Secure Act 2.0 and get passed at the end of this year. So just be on the lookout. Obviously, if either of those things pass or both of them do, we will certainly be updating everybody about what the new rules are. And the final thing that I was just going to mention briefly is that more and more states are adding these new mandated retirement benefit programs. We're up to 16 states. There seems to be a few more added every year. Basically, they apply if the employer does not offer a retirement plan. Some of them are much broader. It just basically says the employer has to offer a retirement plan. Others say it has to offer them to all these people, and if it doesn't, to any of those people, it doesn't offer the plan, then you have to automatically enroll them in the state mandated plan. So we have kind of done the research for each state and have a memo that we can provide to anybody that has employees in multiple states. If they're not sure they're in compliance with these requirements, certainly reach out and we will provide that to you. But some of this stuff always in the back of my mind makes me wonder if the IRS and the Department of Labor keep hitting clients with significant penalties for what are relatively minor errors in a very complex regulatory world. There may be more employers that just start saying, we'll give up. We won't have a retirement plan. We'll just contribute to these state mandated retirement programs. They're generally not going to be as good for the participants, but obviously the employer has to stay in business and focus on their business as well. So I always tell that when I talk to IRS and DOL agents, and certainly Congress needs to be aware of that too, that they can't be coming down so hard for relatively inadvertent minor errors that any client is going to make when the rules are this complex, and expect them to continue to offer these benefits to their participants. That's all I have for today. I thank you for your time, and certainly reach out if you have any questions about any of these things. And if not, then we'll look for your questions for the December 16th webinar, and we'll try to answer as many of those as we can. Thanks and have a good day.